So the previous topic was a very general high-level summary of economic news events. Now we're going to become a little bit more specific and we're going to look at what exact news events that we want to be trading, because some will move the markets more than others. So as a quick overview, let's have a look at what it all means to us. So as we saw in the last section from the calendar examples that we saw, there are many news events released each week. However, not every single one is going to move the market. We want to identify and therefore trade the economic data points which have the largest potential to move the markets, because that's how we make our profit. We need the markets to move to generate our profits. Now, generally speaking, there are data points which the big institutions will focus more on than others, and we'll talk about these in a second, because we want to know what the big institutions are trading, because if they're not interested in a particular data point, the market won't really move, and that's the last thing we want to be doing. Now, data points can also be nation specific, meaning that if the central bank of a particular nation comes out and communicates to the market that certain data points are more important than others, then naturally the big banks and the big institutions will focus in on those. For example, back in 2014, late 2014, when the Eurozone was in a bit of trouble, the ECB came out and were very explicit by saying the key data point that we're concerned about is inflation. Inflation is very low, and if it doesn't improve, we are going to have to take action, i.e. we're going to have to weaken our currency. So when they said that, every single inflation figure had some massive moves, because the market, the big market participants, were focused on that because the central bank had confirmed that they were focused on that. So sometimes data points are very nation specific, sometimes they're just general. Now we will use, as we've seen briefly, a free online economic calendar called forexfactory.com, as this will give us visibility every single week of what news announcements are coming out. What's also great about that calendar is it will tell us and help us filter the highest impact news events from the medium and the low impact. So that gives us the ability to then become very focused on certain data points rather than trying to trade absolutely everything, which would be pointless. Okay, so in regards to Forex Factory, we want to concentrate on the red impact news events, because these have the potential for the greatest reactions in the market, the greatest movements. So we want to focus our attention and time on trading these high impact red flag news events. Now, as a trader, we want large moves from these news events, because that helps us push our trades into a profit, which is essentially our end goal. So the greater the movement, the greater the profit, or the quicker we obtain a profit. As a trader, that's exactly what we want to do. We want to obtain as much profit and as quickly as possible. So when we get the news announcements right and we trade those that have the potential for the greatest movements, this more often than not happens. As we saw in the previous topic, we saw the example of the New Zealand dollar, the Kiwi dollar, the dollar CAD and the Aussie dollar. Huge moves, over 100 pips on the Kiwi dollar, 100 pips on the dollar CAD, and over 60 pips on the Aussie dollar. That was because all of those moves came off the back of red impact news events. So you've seen first-hand examples of the reactions you can get when it's a high impact event. Now, I'm going to go through a full demo separately in a separate video, going through Forex Factory in a lot more detail than you're getting it now. So don't worry about how you filter and getting familiar with the website, because I'm going to go through that in a separate video, which is purely dedicated to giving you a full in-depth summary of how to use forexfactory.com. But it's a fantastic piece of kit, something that's a massively important tool to me that I use every single week to plan my trades. And also, So we want to concentrate on the red impact events, but what we also want to concentrate on is events which relate to statistical data or numerical data. Because sometimes you can get news events where there is no physical, numerical or statistical release. I.e., for example, if it's a speech, it could be high impact, but there's no number released. There's no statistics released. We want to avoid these for now. We can trade them later down the line, but for now we're going to avoid these because statistical releases or numerical releases are much more black and white. It either tells you it's a good release or a bad release. With something like a statement or a speech, you can get conflicting opinions within that, which make it a lot harder to trade and more grey. We want things to be black and white, of which numerical data are. If it comes in better than expected, it's very black and white. If it comes in worse than expected, it's very black and white. It either gives a currency strength or weakness. So what do we want to focus in on? We want to focus in on these following 8 data points, and these will be relatable across all different nations. And the following are interest rate decisions. This is where a central bank will make the decision on whether they're going to keep an interest rate on hold, whether they're going to raise rates, or whether they're going to cut rates. Raising rates is good for the local currency. Cutting rates is bad for the local currency. Secondly, we've got CPI and core CPI, which are inflation readings. Inflation, when inflation is worse, it is bad for the local economy and the local currency. If inflation is rising and improving, then that is good for the local economy and good for the local currency. GDP figures, which are gross domestic product, again, if it comes in better than expected, good for the local currency and the local economy, bad for the local currency and bad for the local economy. Same with employment figures. Manufacturing, exactly the same. Better readings are good for the local currency, worse readings are worse. Trade balance, again, same thing. Consumer confidence, exactly the same thing. And retail, exactly the same thing. So as you're seeing all of these data points, because they're numerical, if they come in better than expected, good for the local currency, good for the local economy. If they come in worse than expected, bad for the local currency, bad for the local economy. So these are very powerful news events. The first 4 are what are deemed as tier 1. So the highest impact you will get from these events. The second 4 are still high impact, but they're tier 2, so they're slightly lower. So if I had a preference, it would be to trade the first 4, because these, generally speaking, create the biggest movements. But I will trade all 8 announcements, so long as we get a big deviation from what is expected, as we'll see in due course. So, as the bullet points say, each of the above releases will provide a physical number which makes the result very black and white for you as a trader. It's either a good result, a bad result, or indifferent. We obviously want the good or bad result because that will create strength or weakness, which we will trade. The first 4 data points are generally seen as the high impact news events, and the latter 4 are tier 2. The outcome of each data point will affect our trading decision, as you will see in later topics, because remember, I've already said once, and I'll keep repeating this, is we're looking to trade a strong currency against a weak one. If the data comes out and gives us the ability to determine whether a currency is weak or strong, that helps us with pairing strong against weak to find the greatest and the highest probability opportunities. And when a release happens, it comes in the following format. There are 3 key elements. There is a previous number, and this is simply the figure which came out last time the economic outcome was issued. So, for example, last month, what was the employment figure? So the market already knows that. That's not really that important to us. Then there's an expected. So this is where a group of analysts will give their opinion on what they expect the number will be in the forthcoming release. So they will make an expected decision in terms of the data output. So the analysts from the top banks, what do they expect the figure to be this time around? And this is normally given a week before the release. So the market, in advance of the actual release, already knows what they should expect from the release. So they have an idea of what they expect. And then finally is the actual figure. And this is released at the exact time and date as projected on the economic calendar. This is the final outcome. So as we can see here, I've just identified one economic announcement just to show you what it looks like on the calendar. So as we go through them, first and foremost is the date, Tuesday, July the 7th. The time that it's coming out at, 5:30 a.m. GMT. The currency it's going to be impacting, which is the Australian dollar. The red flag means that it's high impact. The cash rate is just showing us that it relates to the interest rate decision. And then on the right hand side here we have the actual, the forecast and the previous columns. So coming into that event, we already had these two figures here. We knew that last time the interest rate was 2%. The analysts from the big banks expect it to be 2 this month. And then when the actual figure was released at 5:30 on July the 7th, it came out as expected. So that's just to give you an example of how it looks on the calendar. We already get the forecast and the previous. We just wait for the actual, and what we want to see with the actual is a deviation from the forecast. So in this example here, we probably wouldn't have got much of a reaction to this particular announcement because the market knew it was expected at 2%. When it came in at 2%, there was no real surprise there. So what does actually create a big movement? In the previous example, probably not much of a movement because the expected was the same as the actual. What creates a big movement and what we are always looking for as a trader is when we get a deviation between the actual figure and the expected figure. So as it says here, when the actual figure is different to the expected, we get a big reaction. To cut that down into more specifics, when the actual figure is better than the expected, generally the currency will strengthen. If the actual figure is worse than the expected, generally the currency will weaken. And as it says at the bottom, this is really important, the more significant the deviation, so the bigger the surprise, the greater the movement. So we're always wanting to look for the biggest deviation possible because it's almost like the market gets shocked and that creates these big movements. So the greater the deviation, the greater the movement. And sometimes you will get no movement whatsoever and no reaction, even to high impact events. What normally causes this is when the actual figure comes out as expected. The market's not shocked, they knew that was going to happen, they expected that, and we would not expect much of a move from that. On these occasions, we would not look to trade anything because when there's no movement, your profit potential is capped. So there's just no point taking a trade where the probability of a move taking place is very, very low. We want to get those big deviations between the actual figure and the expected figure. So just to summarize this, we only trade statistical or numerical data because it's very black and white. It's either better than expected, worse than expected, or the same as. We want to concentrate our efforts on the highest impact statistical data, which we know how to obtain. We go onto Forex Factory and we look for the high impact events, specifically concentrating on those 8 data points that we looked at on an earlier slide. Reason why we concentrate on those is because they are the highest impact, so they give us the potential for a bigger move, which is obviously going to equate to a larger and quicker profit. Now we always look for a deviation from the expected figure, i.e. either a better or a worse figure than what was expected, as this will create the movement that we need to generate our profits. The more significant the deviation in the data, the greater the reaction will be. Generally speaking, good data will strengthen the currency affected by the news. Bad data will weaken it. So that will give us an idea of whether we believe a currency is going to strengthen or weaken. which will then be used in our trading plan or our trading idea to determine which currency pair we will trade. You'll use Forex Factory every single week. It will become your best friend for a full calendar of the news events coming out, so you can plan well in advance as to what you want to trade and when you want to trade it. In a separate video in this same section, you will see a separate video which will give you a full rundown on how to use Forex Factory to your advantage and to get yourself set up so you can start looking at it from literally now.